I'm with Ed Rosenberg of Russell Investments. He is the head of ETF product. Ed, what do you think of the conference so far?
I think it's beautiful being outside. We've just begun, but compared to other conferences, being outside adds a nice value to it.
Yeah, it's certainly better than other conferences I've been to.
Yes, and there's a lot more people here.
Yeah. I'd love to just dive right in. What are you seeing out there for advisors? What are people really not talking about enough that should be on advisors' mind with maybe they're at the conference or building their business or
Yeah, I think the biggest thing, and I've talked about this for a while, is really understanding how ETFs are constructed, right? And what I mean by that is we pick names, right, like large cap values, or we put expense ratios out there to make them attractive. And we make everything simple in that construct. But what's missing is how do we put that together to get that? And if you think about something as simple as large cap value, which I mentioned a minute ago, and look at Morningstar category and just look at yearly performance year over year, you can see the top and bottom performers can have as much as 4,000 to 5,000 basis points difference. And if you're an advisor who picked one and got underperformance or maybe outperformance that you didn't expect, not knowing why that happened is more important than actually picking, like just saying the ETF. You really want to understand how it's constructed, how it gains exposure, why it does that. Buying something because it trades a lot or has a low expense ratio or has a name, whatever company name you like, is not the right approach. It's really understanding that thesis that is put forth and understanding what it's going to do on all different market conditions, whether it's something as simple as a quick drop on Liberation Day or how it's going to behave in like 2008, right? Understanding those things will really let you know what you should invest in and really steer you to the right ETF.
yeah. What are the types of things you guys do at Russell that you think sets you apart from a portfolio construction perspective?
So Russell uses a phrase, open architecture. I always find it funny because I relate to IT on that. But what we mean by that is we do manager research, and that's part of Russell's history. The open architecture is we put multi-managers together to create that investment vehicle. Our approach is to combine those managers using a proprietary piece on top of how we combine them. We're actually going out and hiring what we think is the best, and we can change them and go from A to B. And for us, that's what makes the difference. We're not married to one person. We're married to putting the best strategy forth for the investor, whoever that is, whether it's an advisor or the end client.
Culture. How do you go about identifying these managers, kind of finding those hidden talent?
So we have a research team that's been doing this. It's about 50 years, has been doing this manager research. And so they score all these managers on a rating. Let's say it's small cap, right? If it's a small cap blend, what do they do? How do they do it better? Why do they do it? And they really dig into the approach and rate those managers internally and then share that with the investment team to figure out who they should use.
That should work. From a broader investing perspective, where are you guys seeing value these days at just conceptually? Is it, large caps, obviously, from a big cap, tech perspective, done so well for so long. Small caps, I think, we're seeing a moment of, are they going to finally revert to the historical mean and start to outperform? But we haven't seen it. Where do you think we are?
So I think it depends on your perception. So I think if you look at how the economy is shaping up, not what the numbers are going to tell us going forward, there's a couple areas that could make sense, right? If you're lowering rates, that tends to benefit the small cap companies more than anything. And look, we've all talked about small cap. When's it going to come due? It had a moment here or there, but if rates get lowered, small cap can perform better in that environment. Now, the other side of rates lowering is it tends to have an impact on the dollar. So it weakens the dollar. And if you think of the policies that are in place today, growth around the world is going to slow. All right, we're seeing signs with that. We just saw a jobs report that no one's really hiring in the US. So if growth around the world is going to slow, where's it going to slow the most versus the least? And from what we're seeing, we think it's actually going to slow more in the US than it will in places like Europe. So if you have a weakening dollar, along with potentially a slower growth in the US versus Europe, the placement to be might be investing internationally and increasing that and dampening your US a little bit, which is hard to say because if you look at those large cap stocks you mentioned and the US, the market itself, it significantly outpaced everywhere else for a long time.
Yeah, everyone's felt like this is going to be the month or the quarter of the year where that stops, and then it just really continues to roll on. There's always seems like another catalyst, whether it's AI or whatever else that powers large cap,
Right.
even pull. Or
And if it helps, Russell does have 5 ETFs to share with everybody, and one of them does cover the international space. One of them covers small cap.
Gotcha.
We do have others, infrastructure, global, which I always find fascinating. Global. Most people don't know how to use it, but I find it fascinating. And then emerging markets. And everyone has, it's interesting about emerging markets the most is everyone has very strong opinions. They either like it or they can't stand it. And there's not much in between for some reason.
Yeah, it's pretty polarizing. Tell me about infrastructure. I think as we head into potentially some economic uncertainty, a lot of people think about infrastructure. How do you guys approach infrastructure investing?
So it's from an active approach. So if you look at the ETF space, there's not a lot of active infrastructure out there. There's a lot of index products, and they're what I would describe as old age infrastructure. The way we approach it is from an active space, but we'll also incorporate a little bit of that new age as well. So like you're going to have the roads, your tolls, your ports, but you're also going to get a little bit of exposure to server farms and things like that in there. And as you go forward, what's nice about being active in this case is the active managers can really look for that value in those philosophies and see the changing landscape of infrastructure versus index, which unless you change the methodology, doesn't adapt to these things. But infrastructure is really dependent on a couple of things. A lot of it's dependent on government spending, whether it's local, state government or federal. And then if you go global, it's obviously dependent on those countries spending more money on the infrastructure aspect to develop, add to those things and create more value.
Yeah, which I think people expect generally to happen in Europe and to see more government spending coming.
I think you see it in Europe. And I do think the administration wants to develop better infrastructure here in the US, whether it's on a state level. I don't know about you, but every road I drive feels like it's under construction. As well as from a federal level, like even some of the stuff that's happening in DC and how they're changing things, a lot of that can be infrastructure as well.
Ed, thank you so much for joining us today. It was great to talk.
Thank you for having me. I appreciate it.
Thanks, Ed.
Thank you.